we had sort of two versions of at least what the market saw and what's going on. One is we got to be worried about inflation. It may be sticking around. The other is don't worry about it. It's a long way off. It's not the bigger problem. Which was right?
Well, I'd categorize this market as all greed and no fear, and that's exactly what you saw this week. If in finance we're taught the law of 72, which essentially means if you're annualizing your returns at 7% a year, you're going to double your money every 10 years. The PPI clocked 6.2%. That's really meaningful because by that same math, you're losing half of your purchasing power every 11.2 years. And this is what the market really needs to be focused on. Inflation is here to stay. It's not transitory. Powell tried to paint it as this inflation rat going through the anaconda. We all see the bulge and it's moving. Don't worry about it. I disagree because of the way inflation is calculated. It's a year-on-year number. So sure, used cars being up 35% this year may be part of a reopening trade. Lumber being up may be part of a reopening trade. And people going back and stop working on their porches, maybe why lumber's falling. But things like wage hikes, that's sticky. That's not falling. And so even if you had 0% inflation next year, that's still a 6.2% increase in the cost of goods. So that, in my opinion, is permanent. The other thing I would say is that Powell kept talking about an inclusive and equitable recovery. And what you've gone from is an administration that was obsessed with wealth creation to one that's really obsessed with wealth redistribution. That is inflationary as well. And you also look at the Biden administration, they're quite focused on decarbonization. That is going to take a sustained investment, and investment is inflationary. So for multiple reasons, I think inflation is here to stay. I think it's being underappreciated, and it's something we really need to focus on.
So Chris Ailman, give us your perspective. You are a long-term investor. You have a lot of money to invest. You also have a lot of obligations in the out years. At this point, are you adjusting your investment calculus because of the prospect of increased inflation?
We are, and I agree with Barbara Ann. I think that inflation is here to stay, and I think that it's subtle and creeping in. The way the government measures CPI is not effective at all. But if you ask the average person, they're feeling it. They see it in prices they're paying. And as she pointed out, it's going to be a wage pull as well as a price push on inflation. So I'm not sure when CPI will really pick it up, but I know we feel it and it's showing up in lots of different places. So as a long-term pension plan, as you put, David, with a 30-year horizon, inflation is the real threat. So we're actually increasing our inflation-sensitive assets, which is a whole basket of different things, and increasing it pretty steadily over time. We really want it to be a larger percentage of our portfolio.
So, Barbara, let me ask you about something. There was a little bit of a debate this week on Bloomberg between Savita Subramanian of Bank of America and Jonathan Golub from Credit Suisse about whether an investor should take into account the ability of a company to pass on increased costs to customers. Is that doable? Because some people think it is something that is that one way to try to compensate for inflation we're expecting?
Absolutely. I mean, I think you want to invest in companies with a high inflation pass-through rate. If you look at something like Amazon, it's nothing more than a price comparison website. If you're selling white goods through a price comparison website, it's really hard to pass through those costs. You also had Whirlpool this week say they were trying to increase costs, but the price of steel is up substantially. It's going to hit margins. So I don't want to be in those companies. I want to be in companies with a very high inflation pass-through rate.
Chris, let me ask a slightly different question. Another thing that happened this week was infrastructure. I mean, it's not there yet, but certainly the president announced a bipartisan agreement. It looks more likely than it did last week. I think it's fair to say that. To what extent does that affect an investor's perspective if, in fact, we get a substantial investment in infrastructure? What does that mean for the long-term growth of the economy?
Well, David, I remember you and I talking about infrastructure a couple of years ago. You watch Washington much closer than I do. So yes, we got closer. I'll believe it when I see it. But longer term, I think it is an interesting area. We really do think that internet service is an infrastructure type of investment, broadband, and the charging stations. That's reality. That's going to be an investment opportunity. The government needs to step in and be in the first loss position, but I think you'll see private capital flow. There's a ton of capital, not just in the USA, but around the world, that's very interested in long, stable returns from an infrastructure play. And they love the USA because we have a rule of law, we have very clean rules and contracts, but they've got to see an opportunity where they can make a steady return out of it. So the USA always has that challenge in infrastructure. Municipal bonds are always the cheapest form of cost of capital to build something. But let's face it, they're not good at maintaining it. So if you want to build something and maintain it, you've got to have some private capital in there. And that's going to be the challenge with this bill, is figuring out, with all this federal money coming in, how does private capital fit in that capital stack?
Barbara Ann, what about you? Do you take into account a possibility, an increasing possibility, I think it's fair to say, of an infrastructure investment when you're doing your investments?
I was very pleased with what I heard. 19% of it is going towards EV cars, buses, grid resiliency, environmental remediation. This is all good for growth. This is all job creation, and this is going to make our economy more sustainable and more resilient. So I'm encouraged.
I'm curious, Chris, we've seen a lot of growth in 2021 so far. It looks like we're going to have a very robust year and probably into 2022 as well. Let's be honest, a lot of it's supported by monetary and fiscal stimulus from the government. What do you see in the out years? Are we changing the trend line on growth for GDP, or are we just giving a temporary infusion?
Well, David, I push back on you. I think it's almost entirely from government stimulus. I mean, look at personal income. The reality is personal income is going to go down in the fall when all these subsidy programs and unemployment benefits wear off. And, people, at least out here, I'm seeing in California, having a really hard time hiring hourly workers to do jobs in restaurants and other areas because they make more by staying unemployed. But that changes in the fall. And I don't know if they're going to be really happy to go back to work finally and at less money. But I think that, the GDP has been supported. We've seen it bounce off such a low when we shut it down a year ago. But I'm worried about this fall, not just the out years. I really think that we're going to start to see some struggles and lower GDP as we come back to work. It sounds crazy, I know, that we're going back to the office, but we might have lower production levels. It's something we're going to have to work through, and I may be wrong, but we'll see.
Chris, fair enough. I was trying to be gentle in the way I described it, but you may be right that it really is entirely because of the stimulus. So, Barbara Ann, to wrap up this segment at least, are you concerned about perhaps a hangover from all this monetary and fiscal stimulus?
Absolutely. It's hugely inflationary. And, as Chris says, we've got to get people back to work, and you get what you pay for. So instead of extending employment benefits, maybe we need to start sign-on bonuses like the Hilton and McDonald's and all these other companies are doing. There's absolutely going to be a hangover after this great party.